Now we are going to discuss accounting for mergers, acquisitions, and external reconstruction. Amalgamation. Amalgamation means when two or more companies carrying on similar business go into liquidation and a new company is formed to take over their business. Suppose there are two companies, A Limited and B Limited. They decide to liquidate and form a new company, AB Limited. So here two companies are liquidated and one new company is formed to take over the business of A Limited and B Limited. Second one is absorption. Here there are two companies, A Limited and B Limited. These are two existing companies and one company, A Limited, takes over the business of B Limited. Here one existing company takes over the business of another existing company. So one company is liquidated here and another company takes over the business of the liquidating company. In this connection, two terms are the acquirer company and the acquiring company. Formerly, the acquirer company was known as transferor company and the acquiring company as transferee company. Now the term used is acquirer company. The company that obtains the control of the acquiring company or the company which purchases the business of the liquidating company, that is called acquirer company. The purchasing company is called acquirer company. Acquiring company, the business or businesses that the acquirer obtains the control in a business combination. The liquidating company or the selling company is called acquiring company. Purchase consideration. What is purchase consideration? The amount payable by the acquiring company to the acquiring company at the time of purchase of business is called purchase consideration. The amount payable by the purchasing company to the selling company at the time of purchase, that is called purchase consideration. It includes the total amount of shares and other securities issued and the payment in cash or other assets by the acquirer company to the shareholders of the acquiring company. And it should not include the amount of liabilities taken over by the acquirer company, which will be paid directly by the company. So the purchase consideration will not include the amount of liabilities taken over by the acquirer company, and such liabilities will be paid directly by the acquirer company after some days. And payments made to the debenture holders should not be included in the purchase consideration. Four methods are used for calculating purchase consideration. First one is a lump sum method. When the acquirer company agrees to pay a fixed sum to the acquiring company, it is called a lump sum payment of purchase consideration. Suppose A Limited takes over the business of B Limited and agrees to pay rupees 5 lakh in cash. Then we can call it as lump sum method. For example, if X Limited purchases the business of Y Limited and agrees to pay rupees 10 lakhs in all. This is an example of lump sum method. Total 10 lakh rupees is paid by the acquirer company X Limited to the acquiring company Y Limited. So a lump sum amount is given. Second one is net worth method or net asset method. Here the purchase consideration is calculated by ascertaining the net worth of the assets of the acquiring company taken over by the acquirer company. Net worth of the asset is calculated. Then what is net worth or net asset? Net worth is equal to the agreed value of assets taken over by the acquirer company minus the agreed value of liabilities to be assumed by the acquirer company. Total value of assets taken over by the acquirer company minus total value of the liabilities assumed by the acquirer company. At the time of using this net worth method, we have to remember certain points. Let us see one by one. This one is the term assets will always include cash in hand and cash at bank unless otherwise specified. Assets will include cash in hand and cash at bank. Always include cash in hand and cash at bank unless otherwise specified. Second one is fictitious assets. Fictitious asset preliminary expenses, discount on issue of shares, discount on issue of debentures, underwriting commission, then debit balance of surplus account, etc. should not be considered. That means fictitious assets are not considered at the time of calculating purchase consideration. If a particular asset is not taken over by the acquirer company, it should not be included in the purchase consideration. One asset, machinery, is not taken over by the acquirer company, then machinery is not included in the purchase consideration. The liabilities will mean all liabilities to third parties. Only liabilities to third parties will be included. That means liabilities to shareholders and to the company will not be included in the category of liabilities. Only third party liabilities will be included. If there is a fund or portion of the fund denotes liability to third parties, the same must be included in the liability as staff provident fund, workmen savings bank account, workmen profit sharing fund, workmen compensation fund, etc. up to the amount of claim. A fund which is payable to third parties like staff of the organization, workers of the organization, then such amount will be included in the purchase consideration. And the term liabilities will not include past accumulated profits or reserves such as general reserve, dividend equalization reserve, reserve fund, sinking fund, capital reserve, securities premium account, capital reduction reserve account, surplus account, etc. because these are payable to the shareholders. Shareholders are not third parties, so only third party liabilities are included. Amount payable to shareholders will not be included. And if any liability is not taken over by the acquirer company, such liabilities are not included in the purchase consideration. If any liability is not taken over by the acquirer, such amount is not included. Goodwill is included in the purchase consideration. In the case of contingent liabilities, the amount of additional payment should be included in the consideration if payment is probable and reasonable. Contingent liabilities, the amount of additional payment should be included. Example, company B takes over the business of A Limited. The value agreed for various assets is goodwill 22,000, land and building 25,000, plant and machinery 24,000, stock 13,000, debtors 8,000. B Limited does not take over cash but agrees to assume liability of sundry creditors rupees 5,000. Calculate purchase consideration. So here A Limited is the acquiring company, B Limited is the acquirer company. The value agreed between B Limited and A Limited is given, not book value, not balance sheet value. The agreed value is given. Balance sheet value may be different. So the purchase consideration is calculated. Value of assets taken over by B Limited. Only the assets taken over by B Limited will be taken. Cash is not taken here over by here. What is the reason? Because it is not taken over by the acquirer company. So goodwill 22,000, land and building 25, plant and machinery 24, stock 13, debtors 8,000. So total value of assets taken over by B Limited is equal to 92,000 minus sundry creditors taken over by B Limited 5,000. So purchase consideration will be 87,000. So the value of assets taken over by the acquirer company minus value of liabilities assumed by the acquirer company. That is purchase consideration here. Net payment method. And various payments in the form of shares, securities, cash, etc. made by the acquirer company to the acquiring company. Various payments made by the acquirer company in the form of shares, securities, cash, etc. must be added to get the purchase consideration. So the purchase consideration is the total value of all the payments, whether in shares, securities or cash. Here what are the points to be remembered? The assets and liabilities taken over by the acquirer company are not to be considered. Assets and liabilities taken over are not to be considered. Only the amount or securities issued by the acquirer company will be taken into consideration. The payments made by the acquirer company for shareholders, whether in cash or shares, must be taken into account. Assets and liabilities are not considered. If creditors and debentures are taken over by the acquirer company and subsequently discharged, then such amount should not be added to the purchase consideration. If the creditors and debentures are taken over by the acquirer company and subsequently discharged by the acquirer company, then such amount should not be added to purchase consideration. When the liabilities are not taken over by the acquirer company, then they are neither added nor deducted to the amount of purchase consideration. If such any liability is not taken over by the acquirer company, they are neither added nor deducted from the purchase consideration. Any payment made by the acquirer company to some other party on behalf of the company are to be ignored. Any payment made by the acquirer company to some other party on behalf of the acquiring company are to be ignored. If the liquidation expenses of the acquiring company are to be borne by the acquirer company, this can be added to the purchase consideration. That's one important point. If liquidation expenses of the acquiring company are to be borne by the acquirer company, this can be added to the purchase consideration. For example, B Limited agreed to give for every 10 shares in A Limited 15 shares of tonnage. For every 10 shares in A Limited, 15 shares of tonnage. Rupees 8 paid. B Limited also agreed to pay rupees 15,000 cash to discharge the creditors. A Limited has 6,000 shares at the time of purchase of the company. A Limited has 6,000 shares at the time of purchase of the company. And purchase consideration is calculated. 6,000 shares into 15 shares are given instead of 10 shares. So 6,000 into 15 divided by 10 is equal to 9,000 shares of rupees 10 each. And it is given as rupees 8 paid up. So here 9,000 into 8 is equal to 72,000 rupees, 72,000. And cash paid to discharge creditors is rupees 15,000. So total purchase consideration will be 87,000. One more method, intrinsic value method. What is intrinsic value? Intrinsic value is equal to net assets available for equity shareholders divided by number of equity shares. What is net assets available to equity shareholders? Total assets minus liabilities to third parties minus debenture amount payable to debenture holders minus amount payable to preference shareholders. So the balance amount will be net assets available to equity shareholders divided by number of equity shares. This value determines the ratio of exchange of the shares between the acquirer and acquiree companies. So the intrinsic value of the acquiree company will be calculated, as well as the intrinsic value of the acquiree company will also be calculated. And on the basis of this calculation, we will determine the ratio of exchange. For example, the intrinsic value of A Limited acquirer company is rupees 20, and the intrinsic value of B Limited acquiree company is rupees 10. So here for every 2 shares of B Limited, 1 share of A Limited will be issued. So the ratio of exchange is equal to 1:2. 1:2. Okay, for example, X Limited and Y Limited are the 2 companies carrying on the business in the same line of activity. Their capital is 6 lakh and 2 lakh. X and Y are 2 companies. Capital is 6 lakh and 2 lakh. And value of each share is 10. The 2 companies decided to amalgamate. They decided to amalgamate and form a new company, XY Limited. Each share of X Limited and Y Limited is valued at rupees 15 and 25. X Limited value of share is intrinsic value is 15 and Y Limited rupees 25 for the purpose of amalgamation. And we can calculate purchase consideration using intrinsic value. 6,000 shares of 15 each is equal to 9 lakh. 20,000 shares of rupees 25 each. Y Limited rupees 5 lakh. Okay, thank you.